All right, so welcome once again. Today, I promised I was going to do a video on TDI and how we use it to trade the institutional order flow strategy. And that is just about what we'll be doing right now. All right. So the TDI is a very robust indicator, and you can use it in several ways. They have the TDI squeeze. There are people who trade basically off the TDI. If you use BTMM, the Steve Morrow's method, there are several things you could do with the TDI. You could use it for entry, exit, blood in the water, blah, 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 so many things, right? But the way I use it for institutional order flow, and since that is the question I'm getting, I'll go straight to it. I don't consider so many things when I use the TDI. I use it basically for just confirmation of my entries. And I've not taught this on YouTube before. At the advanced level, I also use it for entry for counter trades. You remember that the institutional order flow is basically a trend following strategy, right? I do take counter trades when I'm able to spot level 3 or I see clear divergence on 15 minutes or 1 hour, then I can trade counter. So how do we use the TDI basically? And for those of us who are new, this is what the TDI looks like. Traders Dynamic Index, this is what it looks like. I wouldn't want to bore you with the details of what the names of and the lines are, the volatility bands and the baseline and all of that, right? I don't want to bore you with all of that. I personally believe that the number of indicators you add to your charts also means that you've added a variable to your chart, and that can either help you or most time confuse you even the more, right? So it's to try to keep it simple as possible. All right, so this is what the TDI looks like. We have a video here. I think I'll drop the link in the description of this video where we taught how you could have this indicator on your mobile MT4 because it doesn't come pre-installed on your mobile MT4, but you can also do that, right? So there are basically two things I look at when looking at the TDI. My focus here is the black line. It might have some other form of color in your own. You just need to spot it out. The black line is the focus when we're dealing with institutional order flow. You notice it has some blue curvy lines there. Those are the volatility bands. They actually serve like Bollinger Band. If you understand how Bollinger Bands work, then you should understand how the volatility band works, right? So this RSI line, which is what we use for institutional order flow, when it goes above the volatility band, we say that it is a shark fin. When it goes outside the volatility band, like it did here, right? Outside the volatility band, we call that a shark fin. Here again is another shark fin here. We have a shark fin here. We have a shark fin here, right? Just that. When it goes outside the volatility band, we say we have a shark fin, right? So it's that simple. This is the way I use it, no complex thing. So then we have what we call divergence. We also use this to spot divergence. I'll show you. You could go Google divergence. You actually see a lot of cheat sheets on them, a lot of pictures from them that teaches you what divergence is all about. But in simple terms, divergence can be said to look like something like this. When price action is making higher highs, like what we have here, price action is making higher highs. Let's use price action is making higher highs, and your indicator is making lower low. You say you have divergence, right? I don't want to go into the details of regular divergence, hidden divergence, and like I've said in several of my videos, nobody pays you for defining these terms. Nobody pays you for knowing what to call them. Nobody pays you that for that, right? That is the certificate mentality, right? We are in the waters, and to survive, I don't need to know what the name of the swimming style is, whether front stroke, backstroke, butterfly, whatever. I just need to know how to keep afloat and get out, right? So what I want you to spot out is that price action is doing, creating higher highs. And if you don't understand what higher high is, then you shouldn't even be watching this video yet. You should be going back to Forex 000 or 101 or whatever the name might be, right? So if price action seems to be creating higher highs and your indicator, whatsoever it is, MACD, and in our own case, TDI, and the RSI line on the TDI I just pointed out some minutes ago, is making lower low, we say we have divergence, right? And so in this case, if it's creating lower lows, if price action is creating lower lows and TDI is creating higher highs, we say we have divergence also, right? So when they're doing something opposite is divergence. And there are several types. There are times that price action will create basically an M, just in an M, no higher high, no lower lows, but your indicator is creating something slightly different, not exactly like an M, but maybe first leg higher than the second leg, then we say we also have a divergence, right? So your TDI is flat, your price action is flat, and TDI is doing something different, you say you have divergence. Now there are several forms. Okay, like in this case, they call it exaggerated divergence, where your price action created a normal M, but TDI did something different, right? It's exaggerated. Same thing for a buy, where your price action created a flat bottom and TDI had a slanty move to the upside. In this case, then you say we have bullish divergence, right? Again, I don't want to bore you with bullish or bearish, because what it does is that it tends to want to force you to look for, to rely strictly on TDI. If you're trading institutional order flow, your order flow bias should be derived from the H4. Once you've gotten that on the H4, you simply go look for look at your TDI to get what TDI is saying. Obviously, if you understand your bias already based on your order flow already from the H4, you should know that if you're going to go high, then what we expect is a stock hunt down before going up, right? So remember the AMD, it will accumulate, manipulate, and distribute, right? So you expect it to, for instance, if this is an Asian range and they want to go up, what you expect is that after creating the consolidation, they should manipulate to the downside, which will give us our stop hunt down, right? And distribute up, right? Here at this point, we want to see our divergence, right? So if I'm going up, then I expect my divergence to be happening at the lower part of my TDI. And if I'm selling, I expect my divergence to be happening at the upper part of my TDI. I don't want to bore you with bearish, bullish. Nobody pays you for defining all these terms, right? So here's another example. In a situation at which the new max of price is followed by lower max for the indicator, just another way of explaining it using some other big grammars, right? So price making higher highs, TDI lower lows. Price making lower lows, TDI higher highs, right? Now there's a TDI indicator called iPro or something like that. It can actually draw the divergence for you, even the hidden, the exaggerated, and whatever nomenclature they tie to divergence, it does that. I don't look for all of those. I just spot divergence and I move on, right? Now, why do I treat divergence this simply? Because divergence on its own is just a confirmation. The trade is strictly based on price action. You could as well decide to leave out TDI. But if you love confirmations, like I do, you may want to incorporate TDI on your chart, but don't trade off the TDI. Never trade off the TDI for this strategy. Of course, there's some strategies where everything is around TDI. Well, you could do that. I don't trade that way for now, right? So let's go back to our note, right? So I've defined, or I've given you what TDI is. I try not to define it. And I've also mentioned what divergence is, right? So when do we look out for sharp fin or divergence? Right. And I need to state this again. You don't just go to your chart and simply begin to look for sharp fin for a sell, sharp fin to the upside for a sell, sharp fin to the downside for a buy. You simply be trading overbought, oversold, right? That is, it will be tantamount to you trading overbought and oversold. And that is not what this strategy is all about, right? So when do I spot out TDIs? When do I actually use TDI in my chart as a form of confirmation? Number one, you should have on your H4 determine what your trend is, right? So like this day, or rather this week, at the beginning of the week, we had an order block here, right? We're expecting price to trade into the order block and give us a reason to go short, right? And we did get our reason to go short, right? It actually gave us well over 50 pips here in it at the drop, right? Then came back, broke that zone, eventually giving us a breaker. If you've gone through our video on strong and weak order block, you might understand why we might have been anticipating this push to the upside, right? But let's leave that out. Here we have an order block created the previous week. As price trades into the order block, we remember that we are in a downward trend, right? If you understand the BTMM market cycle properly, you see that we already have the M, V, V. Would we have a possible W for a retest of this source and breaker for a rally? We'll see what happens next week. But for now, we're focusing basically on the order block so created here. And we had a retest of the order block all around this region. So what do we basically do? When we get a retest of our order block, we simply go down to the lower time frame to frame up a proper entry, giving us a lower stop loss, right? We could basically trade using Fibs here if you so wish, but I go down to the 15 minutes to try to see if I could reduce my stop loss, right? You also notice that I have some levels here using the sweet spot indicator. I expect to see reactions around the 50s and the zeros, right? I expect to see reactions of the 50s and the zero level, right? It happens like clockwork, and you want to actually wait out to see what happens at those levels. The next series I'll be doing will be on the candlestick anatomy, and we're breaking out how we could trade the institutional order flow um, using candlestick confirmations, right? So let's go back down to 15 minutes on this particular day. This happened to be the 23rd. So 15 minutes on the 23rd, right? So here we have the retest that we're waiting for. On this day, we didn't have, okay, basically we have this push from this level to this point. And what did TDI do? TDI actually created a lower low. If you know how to use your data window, you can actually use your data window to check out those levels, right? So, but we got divergence at that point, giving us a reason to want to go short, right? So here we have reaction of the double zero levels. Like I mentioned, reaction of the double zero levels. What price did was that price came up to that liquidity point, which happens to be the Asian high, took out liquidity at that point, and then dropped off, right? Usually you expect a 50 pips move within this kind of scenario. You should expect a 50 pips move. But today we're not explaining the moves or the number of pips. We're looking at divergence, right? Now, let's see one other day where we had an entry for this, right? So it tested the order block on the H4, like I mentioned earlier, came back down, then broke it and went straight up, right? So when this happened, when this order block failed, the first question you should be asking yourself is, where is price headed to, right? If you go to the daily, sorry, this template I used, I should have used a different one, but let me do this. Sorry. Let's go down to sweet spot. Show on only these time frames. Great. Just a minute, please. Sweet spots again. To show on only those time frames. Wait for daily. Back. Right. Now, when they broke that level, when price broke that level, the next question you should be asking yourself is, where is price headed to? Obviously, if you understand how to use your order block theory, you should see that you would have seen that there was a bearish order block on the daily at that point. There was a bearish order block on the daily at that point, and we'll be expecting that price might react at that level. So let's take this out. So there was an order block here on the daily, and what price simply did was trade into the order block right here on the daily order block. Now, if we're to go short from here, the question now becomes, what should we do? How would the TDI help us to pick our entry at that spot, right? So there was an order block here. Of course, on the 4 hours, you'll notice that same order block too on the 4 hours, right? So price traded, we're expecting price to trade into this order block here, right? So take this out, take the daily out. Now this is the order block, the last bullish candle responsible for the drop. When price trades back into it, we should be expecting some reaction, even though we are now bullish based on the institutional order flow. You'll be expecting some reaction of this place, right? So I'm just using this to explain how we use the TDI. And so when you come to this level here, when we come to this level, move this to this point now, and this happened on the 24th. Let's see how the TDI would have played a factor upon the retest here. So we'll go down to the 15 minutes. Go down to the 15 minutes. All right, here we are. And notice that reaction straight off the 00 level, straight up the 00 level, giving us a classical M, right? A type 1 M here, right? Giving us a type 1 M at the 00 point, sweet spot, right? Type 1 M. And if you use the normal Steve Morrow's method, you should be getting something like a shift around that point to sell. Notice TDI. TDI gave us a shark fin at that spot. TDI gave us a shark fin at that point, telling us to sell, right? If you use the institutional order flow, of course, you would have marked out your LSB, which will be somewhere around this point. You have your break and your retest and your drop, right? Some person's trading plan wouldn't have allowed them to take this trade off LSB because you're going to have over, let's see, it will be giving you something like close to 60 pips. You would have done a 1:1, but entry is not what we're discussing today. I just need to point out how you use the TDI, right? You use the TDI. Here is shark fin. So I'll give you an example of what a shark fin could do, right? Then let's just do some random search on how we can also use divergence. So back again to the chart, to the notes, to be sure I'm not missing out everything. So we discussed what a shark fin is and divergence. When do we look out for them? Okay, I forgot to mention the 12 candles window, which is the kill zone. If you use ICT to be the kill zone, which will be 4 hours. If you use the 12 candle window, you'll be looking at 3 hours, and that is the first hour before London open and the 2 hours thereafter. Same thing for New York, first hour before New York, 2 hours thereafter. If you use the kill zone, ICT kill zone, it will be first hour before London and 3 hours thereafter, or the first hour, and rather the first hour before New York and the 3 hours into New York, right? So you want to see your shark fin at specific points. Now, because you always see shark fin in your chart, or rather on your chart, and you don't want to trade off shark fins or divergence, right? You want to wait for shark fin to appear or occur at specific time. It is an issue of price and time. Price and time, the combination of price and time. In fact, look at your chart. It's basically a graph of price against time. And you want to watch out for price and time. Every time, price and time. So you need to wait for your kill zones. You wait for price to happen or the trade to come up usually around your kill zones, right? So you also want to watch out what happens at yesterday low, yesterday high, weekly low, weekly high, monthly low, monthly high, or at recent market structures around quarter theory points, right? And that would be 00s, 50 and 25, but more of the first two, which is 00 and 50s, right? You want to see price taking out liquidity at those points or reacting at those points, giving you tweezers, giving you pin bars or hammers, giving you engulfers at that point, right? After they would have walked that level for a while, that will give you some form of M or some form of divergence after working out that level before dropping, right? So, of course, like I said, there are several ways you could use the divergence, but I've restricted it to just this point. When I come into the market, I look at price action first. TDI is just for confirmation. The theory around shark fin is that, okay, when price moves swiftly outside, because the RS idea is measured at the close of the candle. So if price moves so fast, in a case where we have divergence, like in this case here, where price was making lower lows and TDI was making higher lows, or basically being flat, this is a case of divergence. The theory is that, okay, the move down was actually a fake one, right? And that was why price pierced through the volatility band. But like I said, nobody pays you for understanding the theory. Using it and using it appropriately is what matters. So price traded down, creating this. So this might have informed a reason to go long. I'm not saying I traded this long move. I'm just using this scenario to explain what divergence is all about. Again, notice where it happened, right? Notice where it happened at a site level. You want to have those points, price and time. So again, this is an example of a shark fin, an example of a shark fin. The question is it happening at the point you want it to happen? Is it happening inside an order block? Is it happening inside a source? Is it happening inside a breaker? Shark fins can happen everywhere in the chart, but you want to ensure you restrict your use of shark fins or divergence when they happen at key points or key areas where of interest. My connection went bad halfway there. I hope it doesn't affect the video, else I might just have to repeat this. I wouldn't like that. Right, so let's wrap this up basically. Okay, so divergence can be used to spot when possible counter be used to spot, possible counter trade, usually at the end of a level 3. I'll just give one example and we'll leave it at that for now. So here on the 1 hour, this happened with almost all the GBP pairs. I took that with GU, right? So here we have price action creating lower lows and TDI creating higher highs. So if you are in a sell, the order flow is bearish. And on the 1 hour, you can clearly see divergence. It might be an indication that the trend, is rounding up for a while, especially if you find out that it gives you something like a level 3, if you know how to count your levels. That might just be an indication that price might be making a U-turn, right? It might also be a reason to want to collapse your trade. Say for instance, you've been short, it might be a reason to want to collapse your trade. In fact, on the 15 minutes, if you're trading off the 15 minutes and you see divergence, right, against your flow of trade, that might be a reason to just call it quits, take your profits, and take a walk, right? So if there are questions, drop them in the chat box. I'm sorry, it seems like I wasn't too prepared for this, but I just needed to keep that promise before the weekend runs out, so we could have we could practice this for a test during the week. If I need to redo this video, I'll surely do. And I hope we've gotten value. So have a nice weekend and enjoy your journaling, backtesting, and all that traders do over the weekend. Cheers.